Hello. For those who don't know me, I'm Sally Penny. Nice to see you all back to work. COVID is still going on, but we are still here and carrying on with all our usual work. So this is a great lunchtime. Natalie's got a fantastic presentation planned, so I don't want to sort of keep her further ado. And it's not all about stamp duty, as I thought. Where is Natalie? Hi, Natalie. And it's actually about what we should be thinking about. And we've got loads of interesting webinars coming up with Wesleyan. This is the first of it, and they're going to be monthly. So don't be put off, which is what women do, including myself, so talking about the money. It's actually going to be talking about what can you do and can we get mortgages. But I'll leave all that to Natalie. And
Fabulous. Thanks, Sally. Excellent. Well, thank you for joining us today. It's probably an amazing investment of your time to spend a little bit of time thinking about the new changes to the stamp duty changes. Oh, that's two changes. And also it's important to, even if you're not in a position of moving or you are not looking to buy your first house immediately, a lot of people that come to me, I work primarily with lawyers, find it quite an overwhelming experience. So the more knowledge you've got, I think it's the more power you have when you're looking to buy that beautiful house, whether it's your first house or you're buying a portfolio to grow your wealth. So what I'm going to do first is just share my screen. I am just going to go into a presentation and share it so that you can have a look at what I'm looking at as well. You may not be able to see me, but you're going to have the information that you need, hopefully, to make decisions. So who am I? Well, whilst I'm a financial consultant, my job as a consultant is to give people advice on anything from buying their first house right through to estate planning and all the things that you might do in retirement. But this month has been a significantly busy month because of the stamp duty changes. And it's led me to meet quite a lot of people that are quite panicky about how they can make the most of it. So hopefully this presentation will get you to that point. What we're going to talk about today is who Wesleyan are and how they are relevant to you within the legal profession. Financial education, a really big thing I'm passionate about. Making the most of this holiday within stamp duty. And then looking at some of the detail between types of mortgages, saving for a mortgage, and building a strong mortgage application, especially at the moment, because underwriters are really, really specific about the type of people they lend to. In the chat box, put any questions that you may have as we go along, or we can ask questions at the end, but hopefully this should cover most of the things that you may be looking at. So let's have a look at Wesleyan. So who are we? Well, if you haven't been on one of these webinars before, you probably won't know that we've been around 175 years helping professionals with their financial needs. However, whilst we've been helping doctors, dentists and teachers for an ever so long time, we've probably only been helping lawyers for the last 10, 15 years, so it's our baby. So to help us really give that specialist advice, we have an advisory board where we have quite a lot of people from your world who come and show us what kind of things they find that they are vulnerable with financially, things that they want, the advice they need. And from that, we are able to create a panel and obviously offer expert advice throughout your career and into retirement. We have financial advisors near you. Normally we'd come out and visit you, but at the moment we do lots of virtual appointments, and these obviously allow us to look at you and complete your financial journey. I suppose take stuff off of your guilt list as well. We are incredibly charitable, so we do a lot of work with the local areas, especially around Birmingham Hospital where Wesleyan's head office is based. And we also are a mutual. So what that means is we don't have any shareholders. So we are an incredibly large investment house, or we have lots of money under management. And it means we are able to give the profits to the policyholders rather than the shareholders. So that's a little bit about Wesleyan. What do we do with partnership? Well, to try and make us as powerful and able to help you within the legal world, we are affiliated with the Law Society. We work heavily with you guys in Women in Law UK, which has been fantastic. And we also work with local government lawyers as well. And we run various different webinars, events, and we also make sure our advice is able to help you with all the decisions, not just your individual decisions, but also some of the business decisions you might need to make, such as buying into a partnership or getting funding to continue the success of a law firm. So this is something I'm incredibly passionate about, and it doesn't matter whether I am working with lawyers. I've been a financial advisor for 15 years and working in this industry 20. And what amazes me is that we spend hours at school learning useless information. It mentions there trigonometry, the stuff I learned at school, half of it I don't use. Yet we don't learn how to look after ourselves as we make decisions financially and grow our wealth, especially around buying houses, getting mortgages, what we need to do. And when I meet a lot of lawyers, sometimes they end up having to do an awful lot of work that they probably wouldn't have had to have done if they'd known more about financial planning and had more education. And actually, Martin Lewis, I was watching him the other day, he's got a new program, which is Prime Time. And he said that he doesn't understand why it's not much more part of the education system. So we at Wesleyan want to try and empower people to be able to make decisions financially and not feel overwhelmed. Even if those decisions aren't coming around tomorrow, a lot of us will buy a house and a lot of us will need to start a pension, but we need to make sure we understand those decisions and what that means to us. Some of the questions that we get asked a lot in the legal world, I think I get asked pretty much every week. I've got lots of pension pots, what do I do with them? Because a lot of people don't just stay in one job for years. We may move around. Sometimes they come up with, they want to take a mortgage out or they want to look at their pensions, but who do they use? The main thing is that most of my professional clients, they spend a lot of their time helping people, doing their job, and sorting out, especially in lockdown, educating their children as well. So when do they have time to look at their finances? And often it can be only done when they have to, and that can make it a little bit more traumatic than doing it on a regular basis. So they're the type of clients that we tend to see before we've helped them. So this is really good that you're on there, because we're talking about making the most of the stamp duty holiday. So this has just happened in July, and some of it has probably taken some of you by surprise. So let's have a look at it and see whether or not it's relevant to you and you can make the most of this period of time where you can save tax. So what is the change? Well, most of you have probably seen in the press that the stamp duty has really been abolished or is nil up to a property valued at 500,000, which is massive for a lot of people looking to move or buy their first house. So what are the key points? Well, it's going to be there until the 31st of March 2021. It applies immediately to anyone buying a house, or so someone that hasn't completed. And interestingly, 9 out of 10 buyers will benefit from this, and it can save them on average £4,500, if not more. It will not help people buying in Scotland and Wales. And the main thing is if you're looking to move, it's incredibly expensive. Or if you're looking to buy your first house, you will need to have certain amounts of capital available. So by not having to pay stamp duty or reducing your stamp duty liability, it will probably help you move quicker or have more money to hand when you make that decision. So what does it actually mean to you? Well, if you're a first-time buyer, you already did get some relief up to 300,000. But if you were buying a property above 300,000, then you would pay 5% up to 500 grand, and it would go on. So it's probably going to help a lot of people in London and the South East, and to be honest, I think in lots of areas, if they're looking to buy a property over 300,000. What if you're buying a house and, maybe it's going to be more than 500,000 because you're moving? Well, whilst there will be stamp duty to pay, because there are no stamp duty charges up to 500,000, you will have a reduction in what you would have paid prior to July. And it's showing that it could be a saving of £15,000. Second homes and buy-to-lets, you will always pay a stamp duty regardless of the price of the property. And we know that a 3% extra charge was levied against anyone buying a second home or a buy-to-let home. But now, because the reduction in stamp duty has affected those buying a residential property for themselves, this will also follow through to anyone that buying a second property or buy-to-let, because they will pay 3%, but not the additional cost up to 500,000. So again, it's going to make a massive saving for anyone looking to build their wealth or looking for maybe a staycation home, since we are in England for the foreseeable future. So buying your first property, this is something that you need to consider. I think anyone would need to consider it. Some of it is outside of my understanding and knowledge. For example, what do you need from your home? What kind of area do you want to live in? Some people are thinking about, how easy is it going to be able to sell that property? So local knowledge is key. How long you're going to be there is also important, because that can marry through to the type of mortgage advice that you will get. Massive is how much you can borrow. Regardless of whether you're buying your first property or moving, it's important to understand what you can buy and borrow. And even more so post lockdown, because lenders have changed and tightened some of their rules. And how much can I afford? So you might be able to borrow lots of money, but is that actually affordable now and into the future? So the types of mortgages, well, there's probably 3 areas. You've got to look at the repayment method, the type of term you want, and the interest rate. So when we look at the repayment method, there really is only 2 types. When people used to buy properties, they used to do them on an interest-only basis, which meant that they were never ever paying off the debt. They were just paying the interest back to the lender. Usually lenders would want a repayment method, so it used to be in endowments or other properties or pensions. And it could mean that at the end of your term, you still owe as much as you did when you started. Tougher to get nowadays, because you really do need to show that you have a long-term investment that will fund the repayment of a loan. So if you're a first-time buyer or someone that hasn't got a repayment method, generally a repayment mortgage is what a lender would probably offer you. And that's where you pay for capital and interest at the same time. In the early years, you'll pay more interest than capital, but that will obviously change round in the later years. But the best thing about that is it's guaranteed to be paid off at the end of your term. Mortgage types. So most of you read in the press what interest rates may or may not be doing. The base rate is really, really low, but most mortgages are bought on the money markets. So even though the base rate or Bank of England rate is very low, lenders tend to look at the risk to them. They look at the cost of offering you the mortgage. So at the moment, fixed rates and tracker rates are probably not as low as they were pre the COVID and lockdown. What that means to you is you need to think about what you can cope with in terms of payment. If you go for a tracker rate, it can mean that the payments can go up and down. Sometimes those rates can be lower than a fixed rate, and you tend to be tied in to those type of rates for 2 to 5 years. And the rate usually tracks maybe the Bank of England rate or the bank rate at a slightly higher rate. It says generally early repayment charges don't apply, but sometimes if it's a higher loan to value, you will have early repayment charges on that type of mortgage. And the main thing about a tracker rate is if interest rates went up, your payments could go up. And for around every £100,000 you borrow, that could be a rate increase of £40 to £60. So it could be quite significant if you're borrowing large amounts. Fixed rates mean that you are secured into a payment for a period of time, for example, 2 to 5 years, and that rate won't change. The benefit of that is you can budget, but generally you'll have an early repayment charge, which means that if you were to repay it back early or within that term of 2 or 5 years, you could have a significant penalty. Some of them allow you to overpay, but often this is limited to 10% of the starting balance. So if someone was coming into money or looking to pay more than that, these type of mortgages could be quite, would reduce the amount of flexibility you had. Also, fixed rates can be slightly higher or more expensive than tracker rates. And if interest rates go down, or the money markets are lower, you could be tied into a rate which is significantly higher than an average person taking out a mortgage in the future. Offset mortgages are fabulous if you have savings or capital that you want to help with the interest on your mortgage, but you need to retain access to it. And it can reduce down the monthly payments, or it can reduce down the capital you owe. They're usually a little bit more expensive than normal mortgages, so you would need to keep at least 10% of the balance of your mortgage in savings, and if you've got less than that, they often are not worth having. They can be great if you've got, it says self-employed people that are looking to save for their tax, or it could be people that have got large amounts of money which they need for business continuity, but they want to earn a lot more than what they're earning at the moment. To be honest, if an offset mortgage suits you, I can do some fantastic calculations which would show you how it works for you individually, and that can often work out to whether or not it's a valid mortgage for you to take out. And then we look at buy-to-let mortgages. So there's often similar types of things that you can look at with a buy-to-let mortgage, but you often have to come up with a bigger deposit. And at the moment, that's probably a minimum of 25% of the property value. They will look often at the rental income, and they will often ask for a minimum income criteria of about 25,000 earned income. However, some lenders may not have that. They're often not regulated by the Financial Conduct Authority, so they don't have as much protection as residential mortgages. And the main reason for a buy-to-let mortgage is that you're going to rent the property out. So the property needs to be in a situation where it can be rented out immediately. If it looks like a bomb's gone off in it and it needs loads of work and has no kitchen, a lender may decline the application because you can't rent it out immediately. You also need to think about landlord insurance. You may use an agent to rent it, so you'll pay them a fee. Maintenance costs, which if you own your own house, you know what that could be, but it's even more important that you keep things running within a rental property. You'll pay additional stamp duty, and when you come to sell it, you could have tax implications, as well as the rental profit, you could be paying tax, and those things can change all the time. So how do you save from it? What kind of things? Well, this gives an example of what you may need to keep to hand. It says about a 10% deposit here. At the moment, there used to be 5% deposit mortgages, so 90%, 95% loan to value mortgages. They don't really exist at the moment. And if they do, you usually have to get security from savings from family, or even a security from your family's property. 10% mortgages were run of the mill prior to COVID happening. Now there are very, very few 10% deposit mortgages. Actually, they're more likely to ask for about 15% deposit. There are 10% mortgages out there, but some lenders are only coming on with those mortgages for 1 or 2 days. So it's really important, if you're in that position, that you really keep close to your advisor to make sure that you're able to secure a mortgage when you find a property. The great thing is there's no stamp duty at the moment on that type of property, but you might have to pay for a survey, which can be £400 plus. Searches and lands and legal fees can be £1,000 plus, probably more likely to be £2,000 once you get the final bill in. Mortgage fees can be £0 to over £1,000, and it depends on the lender that you're going for. So on average, you need at least a £25,000 fund there to buy a property that's £231,000, but maybe more considering the current climate with lenders. Other areas to look at are the legal costs, cash deposit, term, all the costs, but also some stuff like, how are you going to buy the property? Are you going to buy it with someone? Are you going to do it as a joint tenant or tenants in common? What type of survey do you want? And is it affordable to you? It gives another example of a monthly cost. So it's saying if you wanted to buy a £250,000 house with a £50,000 deposit, so you would need a £200,000 mortgage over 25 years and a fixed rate of 5 years, the estimated monthly cost is £850. But what I would say to you is those figures are taken by a nationwide data service, and they are quite old. So again, when you're looking to buy a property, you may need to speak to your advisor several times to make sure you're keeping up with the type of cost that this could create. Comparing mortgages, you can do it yourself, which is fantastic, but you would need to make sure that you don't just follow headline mortgages. There's always your best friend in the pub that tells you what they did several years ago and how easy it is. But actually, headline rates, you may not fit the criteria of the lender. It could be that it comes with a really high fee. So it's always good to look at the annual percentage rate charge, or APRC. It tells you the type of things that it uses to compare, and all lenders will have to show this. But sometimes it's looking at the fact that you're going to keep that mortgage for 25, 30 odd years. And typically most people remortgage after their initial rate ends. The main thing I'd look at is the terms and conditions, penalties. Do they fit with what you're looking to do? You don't want to be in a mortgage that's got 5-year term with early repayment charges, and actually you want to move in 2 years. And whilst most mortgages you can port, it can be incredibly complex and you have to be reassessed by the provider. So when we look at mortgages, we look at what you're looking to achieve, what fits the criteria you're in, but also does it meet all the other things that might be underlying with the type of mortgage that you need. This is the point of building a stronger mortgage application, especially at the moment. I keep stressing that the market at the moment is substantially different to what it was 6 months ago or even a year ago. So spending a bit of time on your current application or where you are financially will help you, whether you're looking to remortgage, move, or you're a first-time buyer. So the types of things to think about: your credit score is so important. All of you may have reviewed your credit score at one time or another, but it can change all the time. And also, unfortunately, we live in a world where fraud can happen. So it's important to check your credit score regularly, but not just the score, the overall score, but also the underlying. Have you missed any monthly payments? Has anything been happening on your file that you didn't know about? It's so, so important to have a good understanding of your credit score. Every lender has to check your affordability. It's actually a requirement if it's a residential mortgage. So in view of that, they will want to know what the breakdown of your income and expenditure is. They may check your bank statements. They're not looking at what you spend your money in. They're not judgmental, but they want to make sure that that mortgage is going to be affordable. They will definitely need to have an understanding of any nursery fee, child costs, such as private schooling, any costs that they may consider will need to carry on regardless of what happens with your mortgage. They will also look at all your debts. So anything, if you were to be credit scored, would come up on your file. They would want to have a good understanding of that. It's important to try and minimise your debts. You can still get a mortgage if you do have outstanding debts, but if you can make sure that they are well managed and affordable, this can potentially help you borrow more money if needed. If you have lots of debts outstanding, they may reduce down the amount you can borrow. So it's really, really important to talk through where you sit with your debts, and they will include your student loans in that as well. You're going to probably use a lot of your savings to buy the house, so it's looking at the long-term effect. If interest rates went up, can you still afford that mortgage? But also, you may be doing lots of work and projects on the house. So are those affordable? Because I meet people that buy their first property and sometimes they've really built up quite a lot of unsecured debt. So it's really important to look at the long-term affordability of that property. And then lastly, looking at what protection you need in place. Some of that might come from your existing workplace benefits. Do you know what they are? A majority of people don't even know what their sick pay benefit is. And if you have got shortfalls in that area, making sure you look at them and protect them as much as you see fit. And then this is a good time to review your mortgage. I meet a lot of people in the legal world that go on to the standard variable rates for lenders, and that can be incredibly expensive. So 2 to 3 months before your rate ends, it's really important to talk through with someone what kind of options you have. Do you need to remortgage? Do you need to go on to another rate with your lender? Your loan to value may have improved because you've done stuff to the property. You might need to borrow more money. But it's really, really important that if your rate has come to an end, don't wait until 1 week before that happens. Try and look at it 2 to 3 weeks, 2 to 3 months beforehand, so that you can get the application in time if you do need to remortgage. At the moment, lenders are very, very busy. And so sometimes they're taking 20 working days to look at applications. So the more organised you are with the remortgage, the better. So what are the next steps? Well, if you're ready to buy, then I would really recommend talking to a financial consultant within Wesleyan. There will be one within the area that you live, just to talk through what kind of things you're looking at. Even if this is I'm going to look to buy in a year, 2 years' time, it's still important to understand a little bit more of the things that you need to look at. Check your credit score. Then you may come to a point where you start to seriously look at a property. So it may be another appointment or another conversation with an advisor. I sometimes speak to people 3 or 4 times before they even start looking for a property. You will then need to find a house. So that'll be working with local estate agents, and you'll make an offer. Once that's accepted, they will expect you to send them your solicitor details and also a decision in principle, which we can help you do. And then you would move on to a full application. A lender is going to look at, are they willing to lend to you, and are they willing to lend to the property that you're looking to buy? Once they are happy with that, they will look at giving you a mortgage offer. It's saying it takes 3 to 4 weeks, but I would say at the moment it may be 6 to 8 weeks in view of the processing, and obviously a lot of the providers have fewer staff working for at the moment. And then it would go to your solicitor and they'd finish off the legal side of it, where the money's released, you get the keys and enjoy your property. So at Wesleyan, we can help you get the mortgage. There aren't just mortgages for lawyers, but there are lenders that are really good at lending to professionals. And sometimes I have weird and wonderful circumstances where it won't be just a computer says no. You'll have an underwriter who will look at the case on its own merit and maybe agree it, whereas others wouldn't. There's thousands of deals. Some of them we have on the high street, but also it's not just about what's best for it, it's making sure you fit that criteria without ending up credit scoring yourself and spending hours on the phone to various companies. We can do that for you. We manage the application for you. Lenders aren't always very proactive in contacting you to ask for documents, so we tend to check each day or each week to make sure that we're moving the case forward. And the best thing is we don't charge for the advice that we give, and we get paid by the provider on completion, so you don't have another additional cost, which you probably don't want when you're buying your house. So what should you do? Well, some of you will know what you're looking to do, and it's important to get a plan together, which will be your own plan. If it's something that you need more help with, I would definitely review your mortgage requirements, your goals, and sometimes that takes me sitting down with you and asking questions, which you may go away and reflect on and come back to me when you've sort of got yourself in a position to buy, move, or grow a portfolio. But it's really key to seek financial advice, because what you don't want to do is wait until you find the house of your dreams, but you maybe don't have your finances or your circumstances in order to actually buy that house. We cover many things within Wesleyan, not just mortgages. Some people I meet, I've got a girl that I've done a 5-year plan with, and her final goal was to buy a house, but through that time she's got married, she's been saving for deposit, cleared all her debts. And so it's important that at the stage you meet you, I can look at a plan and we can review it annually till you get to where you want to be financially and ongoing as well. So I hope that's helped you. I know that there's a lot in that presentation, some of which you guys may have had that information. I've had some questions in the box, and generally Sally will help me with this, but as you can see, there's my email address. So if you've got any further questions, you don't feel you want to raise on this type of forum, please email me, or you can link in with me and we can obviously arrange a time to discuss things privately. But that's it for the presentation.
So brilliant. Natalie, thank you.
Lovely meeting you guys. Have a lovely day.
Thank
Enjoy
you.
your holiday.